Hello all, I am John Matthew. Welcome to Stock Investing. Have you guessed India's first trillion-dollar company in market cap? It is a bank. It is HDFC Bank, which in my view has the best chances of becoming India's first trillion-dollar company. Largest private bank in India with largest market share in middle market banking, auto loans and payment on cards, accounting for around one-third of all amounts spent on a card in India. Market leader in almost all asset categories and best portfolio quality. When one refers to quality of a banking portfolio, it means lowest amount of non-performing assets or NPAs. Retail loans account for 39%, while Credit Reference Bureau services, in layman's terms, bank guarantee account for 35%, and wholesale loans account for the rest. Needless to say, almost the entire business is from India itself. All data in this presentation is based on the data available in screener.in as on 4th May and the annual reports of the company for the respective years. Forensic accounting checks whether there are any discrepancies in the data provided by the company. The forensic accounting for a financial services firm is different from that of other companies. Treasury income to net interest income (NII). Treasury income is the income generated by the investment portfolio of the bank. A high ratio indicates that the bank's core assets are not performing as well as expected. Here the average is only 2.3%, which is well within the limits. Fee income to net interest income. Banks typically charge high fees for riskier loans, so a high ratio here may indicate a significant amount of loans fall into the high risk category. Here the average is only 2.2%, which is good. NPAs are those assets where the principal or interest or both are not being paid as per schedule. High NPAs are the worst nightmare of a banker. Also, volatility in NPAs may indicate that the NPAs are not being recognized or identified properly. As you can see, there is hardly any volatility and the average is just 1.1%. Provision for NPAs is the amount that the bank keeps apart in case the NPAs default completely. The higher the percentage, the better, as earnings are calculated considering these provisions also. Here the average is around 71%, which is within the expected range. Auditor remuneration is consistent with the growth of the bank and is in expected lines. Contingent liabilities. I am only considering claims against the bank because in the case of banks, bank guarantees are also considered as contingent liabilities. But bank guarantees are part of the business and hence not being considered. It is just 1%, which is minimal. Hence all 6 checks are fine. We cannot use discounted cash flow method to calculate the intrinsic value as banks are in the business of lending and free cash flow more often than not will be negative. Hence we are using the discounted earnings per share EPS method. G stands for growth. Growth rate for 10 years assumed to be 18%. Mr. Shashidhar Jagdishan, CEO and MD of HDFC Bank, in a recent interview said that he expects the bank to grow at a CAGR of 18 to 20% in the coming years. I am being conservative and taking the lower value. Discount rate or inflation assumed to be 10%, the reason for which are given on my previous video on Tata Steel. Present value of EPS after 10 years is 155 and assuming that the PE ratio will continue to be 21, then also as it is now, we get the price per share as 3,224. After applying the factor of safety, the price comes to 2,579 rupees, which means you are getting a discount of 33% even after applying the factor of safety. Now let us calculate the intrinsic value of the share using Ben Graham's revised formula. This method gives you an even better discount of 44%, again taking into account the factor of safety. Here we do the Peter Lynch check, but as you can see it is coming to 1.2, which is well below the maximum limit of 1.5. A few people ask me, why are you taking 1.5 and not 1 as a maximum limit? Well, the simple answer is for a company growing consistently at a CAGR of 20, the typical PE ratio in India is 30. So to say PE by G is around 1.5 for an average performing Indian company. Let us see how HDFC built its moat. In the mid to late 90s, the stock trading was increasingly becoming demat, and HDFC was the first adapter of latest technology. This meant that the exchange could verify whether the broker had the money in her account as long as the account was with HDFC. Also, the broker got the settlement as soon as it was due. This capability enabled HDFC to capture around 80% of the market share. The second was counter-cyclical strategy. Focus on segments which are not the focus of your competitors. In the 90s and noughties, when other banks focused on infrastructure and project loans, HDFC focused on retail loans. And the last 10 years or so, when other banks focused on retail, HDFC focused on corporate loans, thus helping to grow its loan book much faster. Future. India's high growth of around 6 to 8% needs to be funded. So this will provide immense opportunities to Indian banks. HDFC, being one of the top-notch banks, stands to hugely benefit. Merger with HDFC will give a lot of cross-sell and upsell opportunities. Example, a car loan customer can be sold a home loan. Also, this will give HDFC a lot of scale. Quoting Mr. Jagdishan, they are planning to double the number of branches in the next 3 years, which, if it happens, will be an Indian record, because no bank has added around 7,000 branches in 3 years. Also, he expects earnings to double in 5 years, which will again be phenomenal considering the size of the merged entity. NII margin has been consistently above 4%, which is good. Also, as you can see, it increased from around 18,483 crores to 72,010 crores last year, which is an excellent CAGR of 16%. ROA, which stands for return on assets, has been consistently around 2%, which is fair. Capital adequacy ratio, or CAR, has been consistently above 14%, whereas RBI guideline for CAR for a scheduled commercial bank is just 9%, which means it has been better than 1.5 times the expected standard. CASA ratio is the ratio of the amount of current and savings account to the total amount of all accounts. The higher the ratio, the better, as CASA accounts carry a low interest rate compared to other accounts. As you can see, the average is a healthy 44.7%. ROE, or return on equity, is perhaps the most important parameter in banking along with asset quality. ROE has consistently been above 16% and average is above 18%, which is excellent. Before proceeding further, I would like to mention that I have been banking with ICICI since 1998, and one of my home loans was also funded by them. All services that I am enjoying from ICICI have been excellent, and I have a lot of respect for the bank. The purpose of the slide is just to drive home the point of earnings. Which is the biggest competitor of HDFC? And most of us will answer as ICICI. And current ROE of ICICI is 0.1% better than HDFC. But take a look at the equity base. HDFC is around 36% higher than ICICI, which means that the returns will be similarly higher. This is reflected in earnings per share, in which HDFC is 69% higher than that of ICICI. Looking at the risk, management is absolutely key when it comes to banking. Mr. Aditya Puri led HDFC for 26 years since its inception and created the largest private bank and rated by many as the best bank in India. Mr. Jagdishan took over from him in 2020, and while I have high regards for him as a banker, it remains to be seen how the new management team under him perform. The merger will bring a few challenges, and definitely among them will be regulatory and operational challenges. The merger is expected to happen in the next few months. Please expect a hangover due to merger in the coming months. Also, this may present you a chance to load up on shares. Banking is a highly regulated and open business. What one bank does, others can easily copy. So how HDFC continues to differentiate itself in the future remains to be seen. Key takeaways. To summarize, the key to HDFC's success has been the trust that it has built with its customers, whether corporate or retail. A lot of big business houses have their current and salary accounts with HDFC. Also, HDFC had the highest growth in deposit amount for a scheduled commercial bank in India in the current financial year. The equity research report of HDFC Securities is referred by almost all Indian investment bankers and considered extremely trustworthy. Moving on, the bank has been consistently paying dividend and in the last 10 years, except for a year, it has paid dividend every year. As mentioned earlier, be prepared for some correction in the coming months. Track ROE and NPA annually. ROE should be above 15% and NPA should be less than 2%. Please make allowance for 1 or 2 years of exception. Coming to the thumbnail. Post-merger, HDFC's market cap will be around $200 billion US. If the earnings grow at a CAGR of around 18% and the PE ratio remains 21 as it is now, we will have a $1 trillion market cap HDFC by 2033, which is just 10 years from now. Please let me know your thoughts in the comment section. I hope you like the video. If so, please like, subscribe and press the bell button. Also kindly share it with friends and family. Till we meet again, take care and stay invested. Thank you so much for your time.